I've been at conferences where I've said private equity, venture capital is uninvestable, and I've get a lot of people sort of really very indignant and angry because they don't understand what I'm saying. So,
in essence, my job would be to put all the necessary risk management strategies in place in identifying not only the opportunity to invest in, but the right investor that suits that profile.
I'm not going to allow you just to, when you say put all the risk measure, that's just a word salad. What do we mean? What exactly will you put in place that I, as an investor, would trust you to actually place my money with? So one's looking at complementary, not necessarily supplementary.
You're good at deploying and I'm good at modeling, whatever the case is. So it has to be like a similar type of culture. Welcome to IFSA Private Equity's Prosperity Session with Mr. Chris Hart. That needs no introduction. Thank you for joining us today.
My pleasure. Thank you, Frikkie.
Tell us a bit about your background, your start in the financial services industry, in the asset management space.
Right. Well, I started in financial services with really a big career change from being a science teacher to being a financial market economist in the IFSA dealing room. Was there for 9 years, and then I was given an offer to be the chief economist at Investment Solutions, which was a subsidiary of Alexander Forbes. It's one of the bigger asset manager, but a multi-manager. And I was there for the economic research, very similar research, but instead of the dealing room's short time horizon, this is a much longer time horizon type of viewpoint that you had to take, and the actual contrast for me was great. A lot of assets under management, a few $100 billion in assets under management, and I was then appointed the chief strategist. So I loved the career. It really was a great place to work as well. I think that environment gave one a unique perspective. It really was the helicopter view of the industry, because what would happen is that we would deal with the clients who'd actually be passing on the money, but we'd also be dealing with the asset managers to whom we would be placing money. And it's to understand the industry, the nature of what is a growth manager, and what, when they say they're a growth manager, what do they mean by growth? Because two different growth managers would have very, very different portfolios, and likewise a value manager. What is their portfolio? And the whole point about that blending in portfolios and how do you actually change the overall outcome to be more consistent through a multi-manager approach. So it was very, very scientific and intense, and I do believe Investment Solutions was the market leader in that. But it was interesting. One of the things that we frequently, you could say, almost pressured, is you had people coming with the story that we need to allocate a portion of the portfolio to sustainable, responsible investing. And I was extremely prickly because I said, we're investing pension money. Right, and pension money, all of it, we've already got 100% invested sustainably and responsibly. What do you mean by sustainable and responsible investing? It's usually these woke types that have got special interests, and what they're actually describing is a charity. Now, I'm not opposed to charity, but it's not the place for pension money. We can't tell a retiree, because a retiree doesn't have a second chance. Right, when they get to retirement, we can't say we did wonderful things with your money. We saved rhinos and hugged bunnies and all that, but terribly sorry about your retirement.
Chris, you are the chief executive of Impact Investment. That's the
Yes.
company.
Yes.
And that's specific to the idea of the speciality, the impact investing, not just sustainable in that traditional sense, but yes. Can you explain to us a little bit more on that on that point?
What we were trying to do at Impact Investing is firstly to have the right front end to be at least investable, so that you can determine value, etc. That's the first thing. The second thing is that what a lot of these alternative investment don't understand. You don't have a pension money, a portfolio where you say, here's a nice good cause, even if it's viable. You've got to understand what that investment will do in the portfolio. What will it do to the risk return profile, for instance? Will it reduce risk and increase the returns? And if you can't answer that, and the asset class, if I could put it that way, if you can't, if it's not competing with the other asset classes in terms of the risk reward, etc., it has no place in the portfolio. No matter what fabulous cause you are trying to actually promote, you can save the world with whatever you're doing. It has no place in a pension portfolio, certainly in the traditional sense. And this is where I thought we've got to be able to answer those questions.
Chris, in your vast experience in the more traditional asset management space, and where the impact investing that you are focusing and very successful at this specific stage, don't you think that the more traditional way of thinking and investment advice is basically a gatekeeper that keeps investors out of that opportunity?
Absolutely. I think firstly there's regulatory barriers which I think managers hide behind, right? And I say hide behind because this is a space that nobody wants to have their head sticking out. In other words, the tall trees catch the wind kind of thing, and you do not want to catch wind. Okay, that seems to be the attitude. So benchmarks are so important. How are you doing relative to a benchmark? And that sounds like it's an objective way to measure an investment, but benchmarks themselves are problematic. In other words, that we've got these passive managers that say, well, we choose the benchmark, and how we do it is that it's fine, but just choosing a benchmark is problematic, and an active management decision making that you have to do. So the decision is that the industry is fraught with these types of contradictions that you're getting, and because it's so benchmark driven, nobody wants to actually stick their head out and do something different. So we compare what happens, everybody compares each other with what they're doing. For instance, to say, oh dear, if we've got too much NASPAS in our portfolio, what are the others doing? Okay, they've also got too much NASPAS. We can't not have too much NASPAS in our portfolio. And because of the nature of the market, you can have one share running, and if you don't have it, then you're underperforming, right, because of the dominance in the actual benchmark. And that tends to be where we end up with I think, very, very pedestrian performance. And remember, the investor, in other words, the owner of the pension fund or the unit trust, etc., is paying for this, dare I say, lackluster overall performance, even though the minds employed by the industry are absolutely superb. They're the top minds in terms of the analysis that they have to do as to whether you're rotating out of Anglo and buying Billiton or selling Fashini. It's phenomenal, the intellectual capital that goes in it for what then ends up to be quite an ordinary result. And that I think is the conundrum that we face as an industry. And that means, even from a generational point of view, the young people can see, here's my parents who've saved all their lives for their pension funds and their pension, and it's not adequate at the end. It hasn't met their need. And the irony with that is I can remember, Pravin Gordhan as Minister of Finance. He often beat this drum that we do not have a savings culture. And I look at this and say, savings culture? He's talking about a culture of savings, right? And in South Africa, we've got one of the deepest and strongest cultures of saving, Right, when we go back to our pension industry, it goes back into the 1800s already, where people know they have to save for their old age. Our pension industry, from a saving industry point of view, is more developed than most in Europe in terms of first world, etc. And what else is a stokvel other than an actual culture of savings? So when we say we don't save enough despite that culture, right, why is it? And the reason for that is government policy has made saving unviable. In economic speak, it means if I've got 100 Rand now, I've got utility, I spend it and I get a certain amount of utility. I get less utility if I hold on and spend it in a year's time, because interest rates are not keeping up with inflation. And if you earn interest, right, you're taxed on it. If you pay interest, at least from a business point of view, it's a tax deduction. Okay, and I know from an accounting point of view why that works. But from a saving and investment point of view, it's just the wrong way round. In other words, the whole system favors the borrower over the saver. And that skews it already from a point of view of actually getting a decent investment platform. And then we corralled into the staid, very traditional model where the conventional wisdom of what even risk is and reward is, I think, skewed. And I'll just give you an example. For instance, if an asset manager speaks about risk, there is only one risk. He might use words that will describe other risks, but there's only one risk that they're actually talking about, and that's volatility, because you can calculate a number, you put it on, and you can draw fabulous graphs and that type of thing, etc. And that means from the point of view, they'll sell portfolios that are risky and portfolios that are safe. What does that mean? Safe portfolios in cash and bonds, risky portfolios is in equities, and that sort of thing, because they're measuring volatility as the risk. But if we just take another measure like inflation, well, in investment terms, there are no guarantees except one, is that cash will be taken out on a stretcher by inflation. In other words, if you take inflation as your risk measure, cash, which is seen as the safest investment, now is the riskiest investment that you can make. And yet you are defaulted into cash as you reach retirement. And at retirement, the industry's biggest risk might be volatility, but the actual customer, the actual retiree's biggest risk is actually inflation. And the industry is giving entirely the wrong advice.
Don't you think that that's specifically where the alternative asset classes come in to actually give the retiree, the investor, that opportunity?
I actually do believe you have to break away out of the conventional wisdom to actually get a proper solution for yourself, because people who retire now on a fixed income, by the time if they're retiring at 60, by the time they're 70, they're already cutting. If they don't have kids to support them, they're cutting their medical aids, for instance, at a time they need it the most, because life has become too unaffordable and expensive on the income that they're retired on. Right, and this is the tragedy of the whole thing now. From a generational point of view, young people are seeing this and saying, why must I put money in a pension fund? Right, and that's again, a pension fund starts to become problematic, because what is a pension fund? Pension fund is your money, right, that you worked for, that you put in there, from which rights have been taken away. Right, it's like the worst thing you can do with your money is buy a gift voucher. Here you got money that doesn't expire, that you can spend anywhere where you like, and you exchange it for a gift voucher that now expires and you can only spend it there. Right, that's like a pension fund. It's trapping you with your own money, right? And this is why one needs to say there must be better ways to do it. The conventional channels are not working. and yet there's an enormous opportunity behind those conventional channels. We call it private equity or venture capital, but there are nuances behind that. And people say that it's extremely risky. But within each asset class, in any case, if we want to go to conventional speak, in bonds, there's safe bonds and there's risky bonds, right? In even in cash deposits, you can put your money in VBS, right? Or in other words, there's risk associated with that and a spectrum of risk. And likewise in the stock market, where you say it's there's blue chips and there's more speculative shares, etc. And likewise in venture capital, the same thing. There is a spectrum of risk in there. It's not just all risky, and yet the asset classes, put on the thing on the extreme. And likewise with venture capital. And in venture capital, if I wake up at 2 o'clock in the morning with a bright idea and say, right, I need money to actually fund it, that's highly risky. But if I'm going to take my venture and let's say put a Kentucky Fried Chicken on the floor, that's a tried and tested model, etc., and probably will make a lot of money. It might not make as much if your bright idea, really worked and, shot the lights out and that sort of thing. But at the end of the day, one needs to understand there's a spectrum of risk as well in these asset classes.
I agree. Do you 100%? My sentiment, and it's actually my question, is don't we need interpreters, people that are trusted investment managers or specialists or skilled individuals that can help to translate the need and want for alternative investment to vetting and making sure that it happens?
There's two sides to what. One is the actual manager that takes the money and applies it, and what is their track record and ability to do so. But there's the other side is potentially what is the really proper role of a financial advisor, right, is to actually be able to do research and find that there. But the trouble is our financial advisors are stuck in conventional wisdom, old style, normal channels. So they've got a list of investors that are approved by our regulator, okay, who are more clueless than them. And there's the list, and they'll only do half the list because the other half doesn't give enough commission anyway. So there it is. That's the list. If this is different, it's not on the list. Okay, no, I can't do it. So we need a new generation of financial advisors, right? That's not necessarily connected to the wisdom of the industry, understanding just even the simple conversation of what is the real risk of the client versus what the industry is pushing. And the example of inflation versus volatility is that cash is the riskiest investment if you're looking at inflation, and shares might not beat inflation but gives you a fighting chance to beat inflation, right? Much less risky if you're going to try and overcome inflation risk.
You urge people out of a thought process point of view, when taking a look at alternative asset classes, at the venture capital, at the private equity, what would you say people have to do to get involved?
Well, I think the first thing is we need to appreciate that venture capital and private equity are quite underdeveloped in South Africa, and the reason is that they're not listed. It's not really a trusted channel of investment, and part of that is when you've got a government that is so corrupt and pushing that corruption throughout almost all avenues of society, it takes trust, and part of invested confidence is trust. So people stick to what they know, right, which is a unit trust on the JSE. Right, as I say, there's more unit trusts than there are shares listed on the JSE. All it is managers putting together a different combination, right, in different ways, right, and somebody just says we can do it bigger, better, faster than the next person, but as long as it sticks to the benchmark, that's again. So it's basis points we're talking about. In other words, fractions of a percent. That is really the difference, over good time. There is certainly a need for investor education. There's also a need to be able to expose people, right, to the alternative ways, and sometimes one has to look at it where there's structures which can be complicated and expensive, but you can actually generate quite good returns out of that if you've, for instance, there's a tax structure. If there's a tax incentive, for instance, use it, right? It's there, embedded in the Tax Act, right? Why not use it, all right? And that means in many instances, you can say, what's the risk if we take your taxes and convert that into an investment, right? And it goes wrong, you're in no worse position than if you just paid your taxes. But people have a short circuit upstairs, right, to say, how can I convert my taxes into an investment? So, and I can look at some of these investments, if you can convert and the taxman allows that incentive to last long enough, you can actually get a whole pension plan where after 8-9 years of doing it consecutively from the 1 year to the next, you can have 100% replacement ratio for your salary, which means that the guy who comes in at 55 years old has done nothing about their pension and are suddenly worried, you can actually get a full 100% replacement ratio by the time they get to 65, whereas the poor person, just doing a pension plan from their first salary 40 years down the line will maybe get a 60% replacement ratio after doing everything right with their pension, preserving when they've changed jobs and all that, ends up with 60. That's the kind of revolution that takes place because you're actually converting your taxes very high into an investment, into high yield investment as well at the same time, and you get that compounding effect, which investment managers love to talk about. But when you're compounding 1% a year, all right, you're not going to get much compounding even 20 years down the line, all right. But if you're compounding 12 to 15%, that then you can see the power of compounding because every 5 years it doubles. That's what it is, way in excess of inflation.
But I think that's one thing that impact your company. The last 4 or 5 years did very, very well and were very successful in converting the allowable tax legislation into those types of projects and investments.
Yes, not only that, it also gives the small guy the opportunity to get into business with co-funding. Because again, in the funding world, if you go and say, I've got the best idea in the world, will you help me fund? If they say, who else is funding? You're going to be funding nobody else. You go with nothing. But if you go there, you've got a bag of cash. So I've already got this much, will you augment it? You've got a much stronger discussion for that. And as I say, the other irony is when you're actually raising capital, if you ask for too little, you're also going to get nothing. Because the financial services sector has become so top heavy and concentrated that nobody wants to do deals under a certain minimum, and very often business plans that are presented to us are what are called distressed business plan. They think, because it's going to be very difficult to raise the amount that they're doing. So let's step aside. You want to raise 3 million, let's make it 10 rather, and put a proper business plan in place, and you've got a better chance of raising the capital. And so it's that change in mindset from, we live in an age of abundance, and that abundance can actually be reflected also in South Africa's venture capital and private equity space. At the moment, it's a difficult space because of the trust factor, the fact that nobody's putting money in there. The number of projects that need money is just massive, And yet there's a huge billions and billions. We talk about hundreds of billions of dollars in the world that cannot find projects to deploy into.
But if I'm hearing correctly, and is that the alternative investment space, when done correctly,
Yes.
doesn't only provide a solution for the investor, which is a tax efficient, higher yielding type of
Yes.
investment strategies. It also helps to develop the economy, which is
Absolutely.
and that is where I think that a proper investment manager or somebody that's got a skill set
Yes.
can actually play a pivotal role
Yes.
in making the economy tick over and actually increase, because that's the meat and potatoes.
But we are increasingly need the skills of managers that can actually deploy capital from the system, if you like, into actual projects that do things in the economy. Because most are funds within funds. You know, if you're just putting money in the JSE, for instance, it's the JSE is like almost like a fund. So you put money in the fund, somebody else is putting money in the fund, etc. And the fund is going, money is going from one fund to the next, etc. And sort of just doing that circular
Just moving around.
etc. But nothing is really available at grassroots level unless you're a top 40 company. Then you get the best deposit rates, the best borrowing rates. In fact, we use the expression, you know, you're the salt of the earth, but if salt loses its saltiness, you can chuck it on the ground and it's worth nothing. And our financial system as a whole and our banking system have lost their saltiness to the grassroots of our economy. They're not serving those needs. So if we have a look at the fundamental problem where there's, in the world, there's an enormous amount of money that's looking for projects, and on the other side, an enormous amount of projects looking for money, and there's a gap because the projects looking for money are too small for the money looking for projects. So how do you do it? And this is part of what I think we need is an industry of what I call disaggregators. In other words, companies that are able to take the $10 million or $20 million and disaggregate it over maybe 10 or 15 projects, so that you actually have a system where you can actually monitor. Those big funds don't want to do that, and they don't have the capacity or will or anything like that to do it, but they've got certain targets to meet. This helps, you know, all sorts of things. And if you can do that disaggregation, and the technology does exist now, and this is the beauty of the fourth industrial revolution, is that you can start monitoring a township car wash business in real time if you've got the right systems. And there you can take this money and disaggregate it and get the plumbing business going and the laundromat going. Simple businesses, but makes a difference in people's lives. Right. The one thing you'll hear about politicians speaking about inequality, and you can see this in between, say, Santon and Alexandra. That is a globally iconic disparity that we have between the rich and the poor. And they speak about this inequality, and I really do believe inequality is the biggest fraud that politicians have actually forced on us. And I'll tell you why, is that nobody believes in equality. And how you know that is that nobody chooses equality for themselves. So when politicians are speaking about inequality, they're speaking about those people that they see as unequal, but they don't refer to themselves because they don't choose it. And those people they're talking about wouldn't choose equality either for themselves. But I think it's too sterile just to leave it at that. I say, well, what are actual people looking for? And they're looking for opportunity. And it's not even equal opportunity, it's opportunity, right? And that's what capital coming into communities will do. It will help open up opportunities. People will create their own opportunities given access to capital. It's not as simple as that. You've got to have mentoring. You've got to have all sorts of other systems in place to ensure the commercial success of it, because this is not a charity that we're talking about. This is actual investment that we're talking about. So none of this sort of fancy social entrepreneurship or whatever. You need to have proper systems in place. I've got no doubt about that, and proper investment principles, and these investments need to compare with and compete with other investment classes. But I do think at that grassroots level, because there's such a vacuum with an unemployment rate approaching 40% on the narrow definition and well over 40% on the broader definition, you've got an enormous vacuum that will release the energy of people at grassroots level to actually create wealth and create opportunities.
We just need the right conduit between.
You need to the right conduits and to create the right conduits, that whatever's missing, that needs to be done. And there's certain ideas that we can do, but one needs that. And without that, we're going to continue with this miserable revolving door, where we're hoping that large businesses will, create jobs. They never will, okay, because they're always trying to do more with less, cut staff, which they see as a cost, whereas small businesses will always need to employ more people. It's in any economy, small businesses are the engine of growth. The only problem is against a Marxist mindset of central government that doesn't want anything to exist if they cannot control it. Unfortunately, small businesses is a genie that you can't control. Right, it's very difficult to provide controls. And that's the conundrum we have. If I were to frame a question for you, my question is, we've been speaking about the gap between fund managers that really just circulate funds amongst funds versus funds managers that can actually deploy cash to the grassroots. How would you be able to actually generate that link, that missing link as we've got it, including how do we actually build trust for the investor against an environment where trust is lacking to actually attract capital into the space?
It's a very, very good question, and it's something that I'm extremely passionate about when it comes to capital that is available and opportunity that we see. So in essence, my job would be to put all the necessary risk management strategies in place in identifying not only the opportunity to invest in, but the right investor that suits that profile.
I'm not going to allow you just to, when you say put all the risk measure, that's just a word salad. What do we mean? What exactly will you put in place that I, as an investor, would trust you
100%.
To actually place my money with?
The most important part is that you've got, in plain simple terms, you've got capital coming in, you identify a business that is investable. Yes. Making sure that investable business has got enough skills to manage their specific business risk. So we've got cash going into a specific business. There must be assets. Yes. There must be strategies in place, and the business model that we're actually focusing on there must have a high yielding possibility that we, as investment manager, with our financial management skill and modeling capability, that we can actually provide that value out of a financial management perspective. Yes. Because you get brilliant entrepreneurs that are very good in what they do, horrible managers, horrible financial managers. So that's only one of the metrics, or one of the mechanisms that we can actually use, is actually to provide that financial management skill. Yes. To that business.
What we have found, I don't know what your view is, that mentoring is important. Very. And monitoring is important, that you can't place money into a business and hope for the best. How would you go about the monitoring and mentoring side?
It's like buying property.
Yes.
That you actually make the profit when you buy, not when you sell.
Yes.
At that price. So investing in a business is exactly the same. Initially, you've got to perform a in-depth plan that you know what the capital allocations would be, what is necessary, and you've got an array of things that can go wrong, and you have to not plan for each of them, but yes, be mindful of what can go wrong and what can go right. So out of a monitoring perspective, once a month sitting at a board meeting, taking a look at the financials is not enough. If you cannot nitpick and ask the right questions and be hands-on, specifically the initial couple of months, you've got a recipe.
Surely monitoring would depend on the use of technology. In other words, if we're going to disaggregate money, right, to let's say 40 businesses, right, you either have to get more staff or you have to have monitoring systems where it's technology enabled. Right, let's take the township car wash business. You say, here's money, you've got a stall, etc. But surely it's the number of cars coming in and the bank account and the triangulation of what's happening, how long it takes to wash a car, are there any returns, whatever, a feedback system, electronic. These are the things surely that one can put in place that then makes the monitoring quite cheap, but on a mass scale.
I think you spot on that. I say 10, 15 years ago, when technology was developing, but it wasn't so widely available for practical management or practical application. Yes. The last 5-6 years, you've got a lot of independent role players that can actually build systems that can help you to manage that. So out of a private equity or an investable business opportunity, using technology is extremely important in this specific space.
How do we convince your institutions that are sitting with large pools of capital to actually come into the space and actually commit capital to actually make a difference?
It's I think one of the questions that each private equity business actually holds very, very dear. How do you go above and beyond? You've got the retail sector that have got an obvious need for that, but there is, with retail and institutional, you've got a trust barrier.
Yes.
And an institutional investor wants to know that the money that they're investing has got a return, and the people that are managing, they're responsible for that, have got a skill set and they know actually what they're doing. It's very difficult as a startup business. If you've got a bit of a track record and you've got something to prove, or you've proven that you can do this, that will make it easier. But we lack that sweet cherry to make the institutions flow.
Do you not think that this is a space that there should be collaboration?
Oh, yes.
Right. Now, I use that term very specifically because the other associated would be collusion, which would be a problem. But collaboration, where your track record is in one space, mine is in another, but it would make sense that there's synergy and it provides additional comfort. Let's say there's co-funding for a project. My eye looks at that and says, this is my perception of risk. Your eye looks at it, that's ours. There's two different perceptions that help to actually improve the risk management and mitigation of that particular project.
You've got it spot on. And it's exactly what we had a discussion about a little bit earlier, is the more eyes that are on there asking different questions. Yes. You've got a certain skill set and a certain opinion around something, as do I. And that's where you can actually breach that trust gap. Yes. I think it's imperative. Thank you for the valuable insights, Chris. That was a lovely conversation. I'm looking forward to our time together.
Very much. Thank you very much. We appreciate the invitation. I think it's been very constructive. Thank you.
Definitely.